Bond and stock evaluation.
Bond evaluation is the process of calculating the fair value of a bond. Bond valuation typically uses as discounted cash flow analysis, where the future cash flows are discounted back to their present value.
The face value, also known as the par value or nominal value, is the original cost or stated value of a security, such as a stock, bond, or a commodity. It's the amount printed on the face of the security certificate and represents the initial investment or principal amount. The coupon rate is the interest rate paid periodically on a bond or other fixed income security, expressed as a percentage of its face value. It's the rate at which the issuer agrees to make interest payments to the bondholder, typically semi-annually or annually. The maturity date is the specific date on which a bond, loan, or other financial instrument expires and the issuer is required to repay the principal amount, also known as the face value, to the investor. Yield to maturity represents the internal rate of return of the bond, providing a comprehensive picture of its potential return, including interest payment and capital gains or losses. It's a complex calculation that takes into account the bond's current market price, face value, coupon rate, and time to maturity. The discount rate is the interest rate used to determine the present value of future cash flows or earnings. It's a critical component in valuation models, such as discounted cash flow analysis, and represents the opportunity cost of investing in a particular asset or project.
Stock evaluation, also known as equity evaluation, is the process of determining the intrinsic value of a company's stock.
Earnings per share is a key financial metric that represents the net earnings or profit of a company allocated to each outstanding share of its common stock. In simpler terms, it's a measure of how much money a company makes per share of its stock. EPS is calculated by dividing the company's total net income by the total number of outstanding shares. Dividend yield is a financial ratio that represents the annual dividend payment by a company, expressed as a percentage of its current stock price. As a measure of the return an investor can expect from a stock's dividend payments alone, excluding any potential capital gains. The price to earnings ratio is a widely used financial metric that compares a company's current stock price to its earning per shares. It represents how much investors are willing to pay for each dollar of earning generated by the company. The price to earnings ratio is calculated by dividing the current stock price by the EPS. The growth rate is a financial metric that represents the rate of change in a company's financial performance, such as a revenue, earnings, or dividends, over a specific period of time. It's typically expressed as a percentage and can be calculated using historical data or projected future performance. A high growth rate indicates that a company's financial performance is improving rapidly, while a low growth rate may indicate slower or stagnant performance.
Investment considerations. When making investment decisions based on stock valuation, investors should consider several factors. Risk tolerance. Investors need to assess their ability to handle potential losses. Risk averse investors may prefer less volatile stocks, while those with higher risk tolerance might invest in companies with higher growth potential but greater risk. Investment horizon. The time frame for holding the investment is crucial. Long-term investors may be more willing to accept short-term fluctuations in stock prices, while short-term investors may focus on more immediate returns. Financial goals. Investors should align their investment decisions with their specific financial goals, such as retirement planning, saving for a down payment on a house, or funding their children's education. Diversification. Spreading investments across different asset classes and industries can help mitigate risk and improve overall portfolio performance. Market condition. Economic factors such as interest rate, inflation, and overall market sentiment can significantly impact stock valuations. Investors should stay informed about these factors and adjust their investment strategies accordingly. Company analysis. In addition to valuation metrics, investors should conduct research on the company's business model, management team, competitive landscape, and industry outlook. Investment considerations. Investors should use valuation methods to determine a fair price for a stock, but also consider their individual risk tolerance, investment horizon, financial goals, and other relevant factors. By conducting research and making informed decisions, investors can maximize their returns and achieve their investment objectives.
Present value. It is to determine its current worth based on its future cash flows. Okay. The present value is the current worth of a future sum of money or stream of cash flows given a specified rate of return. Face value. The principal amount repaid at majority. Okay. The face value, also known as par value, is the amount the user will pay the bond holder at majority. Also, yield calculation. It's measure that return an investor receives on a bond investment. So this measures the annual coupon payment as a percentage of the bond's current market price.
So there are two types of the yield calculation. The first is the current yield. When we say current yield, it is a measure of a bond annual return based on its current market price. Rather than its face value, it indicates the income an investor can expect from the bond in the form of interest payment. When we say interest payment, it's formed by percentage. So the formula of the current yield is equal to the coupon payment all over the bond price. Okay, let's say for example, for a bond with a coupon payment of 60 and in a price of 1,000. So we're going to calculate it 60 a coupon yield is equal to 60 over 1,000. So we have the result of 0.06%. Why percent? Because according to the definition of the current yield, it is formed by interest payment. That's why it's percent. And the next is the yield maturity, or is known as YTM. When we say yield to maturity, the yield to maturity is the rate of return an investor can expect to earn if the bond is held to maturity, considering both the coupon payment and the capital gain loss on bond pricing. When we say bond pricing, it's referred to the process of determining the present value of the bond based on the discounted value of its future cash flow, which include the periodic coupon payment and the face value repaid at maturity. So the formula for the bond pricing is P is equal to summation of C over the quantity of 1 plus R raised to T plus F over the quantity of 1 plus R raised to the big letter T. So where our P here is the bond price and RC is the coupon payment and R is a discount rate or equal yield market interest rate. The small letter T is the period of time and the big letter T is the total number of the period, and RF here is the face value of the bond. Okay, let's say for example the bond pricing. Let's calculate the price of a 5 years bond with a face value of 1,000 and annual of 6% and the required yield market interest is 5%. So where our C here is to calculate the C, we're going to times the 6% times 1000 is equals to 260. That is our C. And to our also is 5% or 0.05, and our F is 1000, and our big letter T is 5 and small letter t is 5. So to calculate it, we're going to use the formula of the bond pricing. P is equal to summation 60 all over 1 quantity of 1 plus 0.05 raised to the power of 5 plus 1000 over quantity of 1 plus 0.05 raised to 5. So our P here, or our bond price, is, if we calculate it in the calculator, the result is 830.53.